There's a version of financial stability that looks complicated from the outside. Multiple brokerage accounts, a spreadsheet with 17 tabs, a budgeting app that requires a weekly reconciliation ritual and produces color-coded reports nobody fully reads, a system so elaborate that maintaining it becomes its own part-time job, one that most people quietly abandon by February of every year they resolve to finally get their finances together. Then there's the other version, the version that actually works. One account, one fund, one automatic transfer. A handful of rules simple enough to remember without writing them down. A financial life that runs correctly in the background while you do other things, not because it's been optimized to the point of complexity, but because it's been simplified to the point where there's almost nothing left to get wrong. The minimalist version consistently outperforms the elaborate version, not because minimalism is a philosophy worth adopting as an identity, because in personal finance, every additional decision point is an additional opportunity to make the wrong decision. Fewer decisions means fewer mistakes. Fewer mistakes means more compounding. More compounding means the outcome you were trying to engineer with 17 spreadsheet tabs achieved by removing 16 of them. My name is William. Today we're going through the specific minimalist money habits that produce financial stability, not because they're trendy, but because the behavioral research consistently shows they work better than their complicated counterparts.
Habit 1. Own one number and know it cold. Most people who describe themselves as bad with money are not bad with money, they're bad with visibility. They don't know their actual monthly take-home. They don't know their total fixed obligations. They couldn't tell you their savings rate within 5 percentage points. They operate in a financial fog where the decisions get made, but the picture never gets clear. The minimalist version of financial clarity is one number, your monthly surplus. Take-home income minus total fixed monthly obligations. Rent, loan payments, insurance, subscriptions, utilities, whatever remains is your monthly surplus. That single number tells you more about your financial position than any elaborate budget category breakdown. Know it, update it when something changes, and make every other financial decision in reference to it. The person who knows their monthly surplus and makes decisions accordingly is doing more meaningful financial management than the person with the 17-tab spreadsheet who updates it inconsistently and checks it when the anxiety gets loud enough to demand attention. Your number is the foundation. Everything else is built on top of it. Habit 2. Automate everything that should be automatic. The behavioral research on financial discipline is consistent enough to constitute a rule. Decisions made once and automated produce better outcomes than the same decisions made repeatedly by willpower. Savings transfer on payday? Automated. Retirement contribution? Automated. Bill payments? Automated. Investment contribution? Automated. Every recurring financial obligation and every recurring financial priority running on a schedule that doesn't require a monthly decision from you. The practical result is that the financial system you build runs correctly even in the months where life is difficult, where attention is elsewhere, where the motivation that was strong in January has been eroded by March. The automation doesn't care about your motivation, it just runs. The single most powerful application of this habit: set the savings transfer to occur the day your paycheck arrives, not at the end of the month with whatever is left, the day it arrives, before the week's expenses have established any claim on the money. The behavioral difference between saving first and saving last is not discipline, it is sequence, and sequence determines outcome in a way that willpower alone never reliably does.
Habit 3. One account for spending, one account for saving, nothing else. The minimalist banking structure that works for most people below 7 figures in net worth is exactly this simple: a checking account for monthly spending and a high-yield savings account for everything that isn't monthly spending. No cash envelope system, no sub-account for every spending category, no complexity that requires ongoing maintenance to remain accurate. 2 accounts. Money comes in, spending allocation stays in checking. Everything else moves to savings on payday, automatically. The high-yield savings account is not optional. The national bank average savings rate is 0.39%. High-yield accounts are currently paying 4% to 4.5%. On a $15,000 emergency fund, the difference is approximately $600 annually for opening a different account.
The setup takes 20 minutes. The ongoing maintenance requirement is zero. There is no financial argument for leaving an emergency fund in a traditional savings account in 2026 beyond inertia, and inertia is not a financial strategy. 2 accounts, automated transfer between them. Everything else is detail. Habit 4. Buy the index. Stop there. The minimalist investment strategy is not a compromise or default for people who don't know better. It is the statistically superior approach for the overwhelming majority of individual investors, and the evidence for that claim has been accumulating for decades. VTI or FZROX in a Roth IRA, automated monthly contribution, expense ratio under 0.05%, rebalancing never required because the index rebalances itself. Tax loss harvesting never required because the tax treatment of the Roth IRA makes it irrelevant. Research never required because you own everything simultaneously and the companies that deserve to be in the index stay there automatically. The S&P SPIVA data showing that 92% of actively managed funds underperform their benchmark over 15 years is not an argument for finding the 8% that outperform. It is an argument for not playing the game. The index wins because it doesn't pick stocks. It doesn't pick stocks. It wins because it doesn't charge for stock picking, doesn't make behavioral errors, and doesn't panic sell during downturns. Those 3 advantages, compounded across 30 years, produce the outcome that most people who pursue complicated strategies are trying to achieve and consistently don't. Buy the index, automate it, leave it alone.
Habit 5. The one financial review that actually matters. Most financial content recommends monthly budget reviews, weekly spending check-ins, daily account monitoring, and a quarterly comprehensive financial assessment. The practical result of recommending all of these is that most people do none of them, because the maintenance burden exceeds the motivation available to sustain it. The minimalist version? One annual review. 1 day per year where you look at 4 numbers: net worth, assets minus liabilities; savings rate, what percentage of take-home is going to savings and investments; fixed cost ratio, what percentage of take-home is committed to fixed obligations; investment account performance relative to the benchmark index. If net worth is growing, savings rate is above 15%, fixed costs are below 50% of take-home, and the investment account is approximately tracking the index, you're on track. Nothing needs to change. Close the spreadsheet and go do something else. If any of these numbers is wrong, you now know which one and can address the specific problem, rather than performing a comprehensive financial overhaul that touches every category simultaneously and typically produces exhaustion rather than change. 1 review, 4 numbers, 1 day per year. Everything else is maintenance theater that makes you feel productive without changing the outcome. Habit 6. Kill the debt, in order, without mercy. Minimalist debt strategy has 2 rules and no exceptions. Rule 1. Never carry a credit card balance. The credit card is a tool that works in your favor when the balance is 0 at the end of every statement period. It becomes a wealth extraction mechanism the moment a balance rolls over at 21 to 24% interest. The minimalist uses the card for the purchase, pays the statement balance in full on the due date, and collects the points or cash back as a genuine benefit rather than a consolation prize for paying interest. Rule 2. Eliminate all consumer debt above 6% interest before increasing investment contributions beyond the employer match. The guaranteed return on debt elimination outperforms the expected return on additional investment at rates above 6%. This is not a controversial claim, it is arithmetic. A guaranteed 22% return on credit card payoff versus an expected 10% return on additional index fund investment. The debt wins the comparison every time. 2 rules, applied consistently, and no exceptions, for the debt that feels manageable or the card that carries a rewards program good enough to justify the balance. The balance carries no rewards program good enough to justify 22% interest. None of them do. Habit 7. Cap the lifestyle before it caps the savings rate. Every financial upgrade feels earned in the moment it's made. The nicer apartment, the newer car, the subscriptions that accumulate because $15 a month feels negligible at the income level that justifies them. The minimalist habit is a spending ceiling, a defined maximum monthly lifestyle cost that doesn't automatically rise with income. When income increases, the surplus increases, not the ceiling. The surplus goes to the savings rate increase, the investment account, the emergency fund. The lifestyle stays at the ceiling while the financial foundation grows beneath it. This is not deprivation. A household with a $5,000 monthly lifestyle ceiling and a $7,000 take-home is saving $2,000 a month, a 28% savings rate that builds genuine wealth on a timeline most financial content describes as requiring either a higher income or a dramatic sacrifice. It requires neither. It requires a ceiling, decided once, defended consistently against the lifestyle inflation that arrives with every raise wearing the language of deserved reward. Define the ceiling, hold it, everything above it compounds. Habit 8. One rule for every financial decision you haven't made yet. The minimalist approach to future financial decisions, the car purchase, the house, the investment, the major expense, is one rule applied before every significant commitment. Does this move the surplus up or down? A car purchase that eliminates a payment and frees $600 a month moves the surplus up. A car purchase that adds a $760 payment moves it down. A house purchase where the total monthly cost, mortgage, taxes, insurance, maintenance, lands below 30% of take-home moves the surplus in a manageable direction. Above 35% moves it in a direction that compresses every other financial priority simultaneously. The rule doesn't make the decision for you. It makes the consequence of the decision visible before you commit rather than after, and visible consequences in personal finance consistently produce better decisions than consequences discovered after the contract is signed. One question, applied consistently before every significant commitment. Does this move the surplus up or down?
8 habits. None of them require a complicated system, none of them require financial expertise, none of them require a subscription to a budgeting app, a consultation with a professional, or a spreadsheet with 17 tabs. They require one number known cold, one automation set up correctly, 2 accounts, 1 fund, 1 annual review, 2 debt rules, 1 spending ceiling, and 1 question asked before every major financial decision. The financial stability that most people are trying to engineer through complexity is available through simplicity. The simplicity is harder to sell. It doesn't require ongoing maintenance that creates ongoing engagement. It doesn't need an app or a course or a system. It needs 8 habits, built once, maintained automatically, and left alone to do what simple systems do when nobody interferes with them. They work. 8 habits, 1 automation, 1 number. That's the entire system. Subscribe for a new video every week and drop the 1 habit from this list you're implementing this week in the comments.